So I'm going to talk about lower of cost or net realizable value. Your book talks about lower of cost or market. Within recent memory, FASB, Financial Accounting Standards Boards, wanted to simplify the accounting for inventory. And so they said, oh, we're just going to use lower of cost or net realizable value. And we'll just have that one way of doing it. But then a bunch of retailers said that would just be way too confusing. They lobbied really hard. And so now there's a small portion of industries that use lower of cost or market. Most of them are required to use lower of cost or net realizable value. So that's what I'm doing here, okay? So it won't hurt you to read the book, but this is more what you're more likely to run into unless you're in retail, okay? What is net realizable value? If you realize something, that means it's kind of what you get. And so what it is the estimated selling price of whatever your inventory item is, less the costs to complete it, if that's an issue, to dispose of it, and any transportation. Basically, in AC 101, you're just going to be given an amount that is the net realizable value. You're not going to have to compute any of that stuff. So basically, your net realizable value is your selling costs less the costs of disposing of it and completing it and transportation. So the rule of lower of cost or net realizable value is that if your inventory has fallen below what you paid for it, in other words, then you're going to have to make an adjusting entry to reduce the inventory on your books to the lower of cost or net realizable value. So why would this happen? If you look at the pictures I have on the notes, you'll see those old telephones, you see a bunch of big old computers and gigantic old TV sets. And you just have to picture yourself, okay, so you've got a warehouse full of this stuff, and these little flat screen TVs come in, or the iPhones come in. How much is that old inventory worth? It just plummeted in value. And so inventory on our books is an asset, which means it has future economic benefit. What's the future economic benefit of these things? Probably not very much. Okay, so that's the rationale. And it's not just being obsolete. In fashion, obviously, tastes change very fast and all of that stuff. So anyway, so let's just look at a little of the mechanics of it. What we're doing, just trying to get the big picture here, is we've computed our inventory using FIFO, LIFO, or average cost. So we've got an inventory amount on our books. And so that amount on the books is, what we would show as our inventory. It's an asset. And so if the future economic benefit is going to be, less than we previously thought, then we've got to reduce the value of that inventory. And so we're recording the loss on the inventory based on if it's going to cost us less to replace it, the net realizable value is less, then we're going to be unlikely, it's likely rather, that the selling price has also dropped or will drop, okay? So anyway, we're recording the loss in the period when the inventory value, we know it has declined. We don't wait until we sell that inventory to record it. We're recording it when we know the inventory has declined. Okay, so let's just take a look at this. Here we've got the cost. This is what's on your books. This is the net realizable value. And there's two different ways to do it. You can do sort of a whole, hold on just a minute here. Two people talking. Oops, sorry. Jeez. We have two different ways to do this. One is what's the whole inventory method, and you simply say, oh, okay, so the cost of our inventory on the books is $415. The net realizable value is $424. So in that case, the net realizable value would be higher than our cost, so we wouldn't have to make a journal entry. Okay, but a lot of times you have to do it on an individual items basis. And if we do it by comparing each individual item, and this is what generally has to be done for tax purposes, we would say, okay, so which is the lower of the cost of the net realizable value? Well, here it would be the 80,000 cost is lower. On this one, it's the same. Here, it's the 40,000 net realizable value. Here, it's the 72,000 net realizable value. And you notice we're not taking any difference here. We are simply putting down the lower of the two amounts. So cost is lower. It doesn't matter. Yeah, they're the same, but whatever. Okay, so we're just taking the lower amount each time. All right? And so when we add these up, the lower amounts each time, we come up with 384,000 lower of cost of net realizable value on our when we calculate it out. So in this case, our inventory is on the books at 415. Our lower of cost of net realizable value is 384. So in that case, we've got to make an adjusting entry to get our inventory down to this amount. Okay? And so what is that would be? What, 415 minus the 384 is 31,000. Okay. So in that case, we make the journal entry, and presumably it would be like 1231, and we would simply do loss, due to decline. It's kind of a long inventory. Okay, and then we would credit our inventory account, and that would be for the $31,000. This is sort of the preferred way to do it because you're separating out a loss. You're having a separate loss that sort of flags that, yeah, that we're probably writing off some obsolete inventory. Some companies will simply make the journal entry. They just sort of put it right into cost of goods sold. They'll increase the cost of goods sold and reduce their inventory, but that kind of buries it. But either of these journal entries is acceptable. Okay, all right, and then as you get on in accounting, if you ever go on in accounting, for those of you who are going to do that, sometimes an allowance method would be used, but again, we do not have to get into that now. So the key points, lower of cost or net realizable value, the main principle is, if you're going to report an asset on your balance sheet, it has to be show the value of that asset, the fair value of that asset. If you've got inventory that's really only net realizable value is only 384, you really can't have it on the books at 415. Okay, so this is the justification for using lower of cost and net realizable value, and sometimes when you're doing the homework on this, they'll give you the units, okay, and a unit price, and so you will have to sort of multiply them across to get the total cost. So on the homework, you may not just be given the totals, you may have to compute those totals. All right, so I think that's about it for all you need to know right now about lower of cost or net realizable value.